What is going on, everyone? Welcome back, and welcome to the second episode of the Q&A show. I'm actually going to try something this week, just do a little update on what's been going on the past week, so everyone can kind of stay up to date on what's been going on. We just signed contracts on a 360-unit property in Columbus, Ohio, which is super exciting. We've been working on that for a little while. We went and saw it on our trip to Indianapolis and Columbus about 4 weeks back. Really awesome project around the corner from our other property. We just signed the documents and everything to sell our deal tomorrow in Jackson, Mississippi. We've held that for about 15-16 months. That's going to be a really awesome, really solid return for everybody involved. And, we're just continuing to look for new properties. We're going to have some equity from that property. We'll probably roll over into Columbus. We've got 2 or 3 other deals we're looking at. But we're super pumped that we're selling one, hitting a good return, and most of our investors are thinking about rolling into the new one, which should also be a really interesting project. But moving on into the Q&A, picked out 3 questions again from Bigger Pockets. I think 3 questions that are different. They're touching a couple different topics, some in depth, some kind of a brief overview. So without anything further, we're just going to dive right in. So the first question is, I was just researching crowdfunding a project on Realty Shares, and one of the questions raised when I was setting it up was, is it core plus, value add, or opportunistic? Showing my newbie colors here, I'm looking at 20 gorgeous acres with an eye to creating a sustainable village. The rest of the question is basically irrelevant. So the question is, what is core plus, what is value add, and what is opportunistic? So those are 3 different types of assets that you can buy that describes the opportunity in a brief overview. So core plus is basically buying a property, brand new construction, or an older property that's been highly upgraded to almost be a new property in like a downtown or super A plus location. Basically your top of the market, best you can buy, brand new type of property. So you're coming in there and you're basically buying a somewhat headache-free property for a fairly low cap rate, but you've got something that should really hold its value very well and is always going to be desirable for tenants. Now, at what rent and how you're going to do it, we don't operate in that space, so I don't know a whole lot about it, but I do know what it is. It's basically buying a brand new built building, downtown Manhattan, downtown Atlanta, downtown Orlando. That's your core plus assets. Then one they did not include is also something called core, which is, maybe not brand new built, maybe not the top of the market, but very similar, very desirable asset. The next one is value add. That is your deal that is probably older. It could be built in the 2000s. It could be built in the 70s. It could be built in the 40s. And there's some way to add value to that property and make it have a higher cap rate in the future. So what happens is you buy a property based on X cap rate. Let's say it's a 6 cap. With a value add, what they're saying is you can take more money than what you used to buy it for. So let's say you buy a property for $1 million. You can bring an extra $200,000 to improve that property, whether it's through interior upgrades, whether it's for residing the property, paint, rebranding, new parking lot, new amenity spaces, whatever it may be. You're adding value to that property, and you think you're going to be able to take your income from here to there, adding value, increasing the NOI, making the property worth more. So typically what you're doing is you're buying a property for, let's say, a 6 cap at $1 million. You're bringing an extra $200,000 to improve the property in the scenario. So your cap rate on 1.2 is actually slightly lower than a 6 cap. But because you can add so much value or some value to that property, you're going to be able to increase the NOI, and your cap rate on your NOI in year 2, 3, 4, 5, 6 is going to increase over that 6%. So maybe it gets to 6.5%, 7%, 8%, whatever it may be. 8, you're kind of getting high. That would be a very, heavy value add and a lot of value still left. And it's going to help you increase your cash flow in the future. So if you had debt at, let's say, 4% the first year and you're buying something at 6%, you are going to make more than 6% because you're borrowing at 4% and you're operating at 6. Now, if you can get that up to an 8, your cash flow is going to be even higher. If you went to an 8 and you're borrowing at 4, you're probably in the double digits. So it would obviously be a really, really good deal. I'm just going to touch this down a little bit. So that's what value add is. You can bring extra capital to somehow add something to that property and increase the cap rate to make a cash flow and make it worth more. That is probably 80% of the properties out there right now is some sort of value add. Now, opportunistic is value and opportunistic are used very loosely. There is some gray over between them. Opportunistic is basically saying, hey, I'm not, just adding $200,000. I'm going to buy this property for $1 million, and I'm going to put in $4 million into it. So now I'm adding a ton of money into it, and I think it's going to be worth 7, 8, 9 million because I've done so much work. So it's more opportunistic. It's more risky, right? The more you add something to it in a value add or opportunistic way, the more risky it becomes, and therefore the more upside you want on it. So opportunistic could be anything from buying a vacant building, which is something we've done a few times. It could be buying something at 50% occupied, and you buy it for $5 million and you put in $3 million. So it's still kind of value add, but it's more towards opportunistic just because it's more risky. It could be a redevelopment play, which is also opportunistic. You're buying, a warehouse building, you're going to convert it to apartments. So that's what opportunistic is. It's basically a higher risk version of value add. You're still adding value to that property, but it's more risky. It's more opportunistic. It's more opportunity available in that property. So that's the difference between kind of those three. The next question. I have $340K left on my rental mortgage and I'm refinancing it now. I've got two options. 30 years fixed at 3.7% or $1,565 monthly payment, or 10 years interest only at 3.65% or $1,030 monthly payment. I have no W-2, so refinance after 10 years may be a bit of a challenge. What would you do? So just to kind of clear that up, basically what he's saying is the first option is a 30-year loan with a 30-year amortization. So there is no balloon payment. In the second one, it's probably still it's a 30-year amortization, but it balloons at 10 years. So what that means is there's still principal left to be paid. So at that time, you have to do one of three things. You either have to sell, you have to refinance, or you have to come up with the money to pay off the rest of the loan. Most people don't have the ability to just pay off the loan. So really, your only two options are to refinance or sell. Without a W-2, may not be able to refinance. Not sure how he's getting a loan anyway if he doesn't have a W-2. So I don't know why that's the issue, but just focusing on which would you do, the 30-year loan, 30-year amortization with a fixed rate of 3.7, or a 10-year loan, full-term interest only, so it never amortizes, and the rates are almost the same, so that's irrelevant. But basically, would you rather do 10 years interest only and it's gone after 10 years, or would you rather do a 30-year loan amortizing the whole way? For us, we would always choose the 10-year option. The reason being, we don't hold 30, properties for 30 years. That's not our MO. That's not our business plan. That is not what we look to do. That's not what our investors look to do. We also think cash flow instead of principal pay down is significantly better because money in your pocket today is better than money in your pocket 5, 10, 15, 20 years from now. So if we can get a loan that has interest only on it, we're going to take that every single time. And I know what some of the arguments are going to be against interest only, especially for a long period of time, is your leverage does not go down at any point. So if you bought a property and let's say, you got a 65% LTV, loan to value, you're going to be at that 65% of purchase the entire time you own the property. If you have a 30-year loan, or even if you have a 10-year loan that starts amortizing, that leverage is going to go down. But the way it works in reality is a full-term interest-only loan, if it's 10 years and 10 years, if we're comparing apples to apples, you're going to get lower leverage on a full-term interest-only. The reason being the way they underwrite loans is what it amortizes down to. So if you got a 10-year loan with 3 years interest only, or a 10-year loan with 10 years interest only, they're underwriting so that what's left on your loan after 10 years is going to be the same, which is why they'll give you lower leverage on the interest only, and they'll give you more leverage on 3 years interest only, because they're saying after the 3 years, so the last 7 years, the principal you pay down is going to get you to the same level you would have gotten to if you did the full 10 years of interest only. So if it was 75% for the 3 years interest only and 65%, they're basically saying after 10 years, you'll be in and around 65% after the 10 years, just the way it works out, because most of your payments up front are interest, and then every year your balance goes down, so more of your payment goes towards the principal. So that's why if you ever look at a loan calculator and you look at a 30, these are all 30 years, let's say, on a 30-year amortization, the last 5 years, the last 10 years, your principal gets paid down way quicker than your first 5 or 10 years. So in your first 5 or 10 years, you're not paying down a significant portion of the loan, and they'll almost end up being the same, which is why we say, hey, give me the cash today, give me the cash flow today, because I can put it in my pocket and I can go do what I want with that, whether it's put in a bank, put in another deal. If it's, if you really want to, you can just pay down the principal if that's something, you're concerned about. And they'll be saying you have to take that money and put it in your pocket. You can choose to pay down extra principal. So for me, I would take the 10-year balloon and take the interest only, because it's more cash in my pocket today. My monthly payments are lower, and in 10 years, I'm not going to be too worried about a refinance, because time heals all wounds in commercial real estate. So I'm pretty confident that 10 years from now, it's going to be a similar value or more. Now, if I'm concerned about future value in refinancing, I'm just going to take less debt. If it was 70, I'm going to take 65. If it's 65, take 60. And it's all a give or take. And you run scenarios to kind of say, okay, where do I think my property is going to go? And, what is my cap rate and leverage at in 10 years that I'm safe, that I think I can at least get a new loan on that property? In 10 years, you're probably pretty safe just the way things go, as long as you're not 75, 80, 85% leveraged and you're not paying anything down. You should be fine. Most 10-year loans that are interest only for 10 years are 65, 60, 55% LTV. You're more than fine. So that's the route I would go. Last question. I'm analyzing an apartment building, and while doing so, I got to thinking about a question that I had better clarify before going into further discussions with passive investors. For my business plan, I'm thinking an 8% preferred return, and then I'm not 100% sure about the profit split. But since it's my first deal, I thought a 70-30 profit split would be fair. My question is this: is the profit split each year after the passive investors get their 8%, then we split the cash flow profit 70-30, and then again on sale? Or is the profit split only on the sale of the property? Thanks for your help. So when you're doing the profit sharing or a waterfall structure, and I've spoken about this a little bit on some previous posts on my Instagram, so if you haven't seen it, you can go watch that as well. But the way it works is a waterfall structure is saying there's two ways the property makes money. There's cash flow, every month, your income minus your expenses minus your mortgage, if you have it, is cash flow, and you distribute that cash flow based on people's percentage ownership base and the equity they put in over the total. So you have cash flow, and then you have sale. Assuming you sell, we usually do. We usually don't refinance, but assuming you sell, in this case, sale, cash flow, and sale proceeds. And the way it works is that first 8% is per year. So that preferred return is saying the first 8%, because we're the ones operating the deal, we're getting compensated for that. The first 8%, we're not taking any money from the investors in the first 8%. So it's anything over that 8% per year is where we start to take a piece of the cash flow and the sale and put it in our pocket and take it away from investors as a form of compensation for running the deal and hitting returns. So we combine the two. So if, let's say you cash flowed just 8% a year for 5 years, you hit 8% every time, your sale proceeds would then be split 70-30 over that. If you went over 8% a year, let's say every year you cash flowed 10%, The first 8% of cash flow you would not get a part of. The last 2% you would get 30% of. So let's call it was a third instead of 30, roughly, of 2%, it would be about, the investor would get another 1.4%. Yeah, another 1.4%. So the investors per year would make 9.4%. You would get 0.6% of the cash flow because it's 30% of 2%. So that's how that works. So if you go up and down, let's say the first year you do 5, and let's say the first year you do 5, and then the second year you do 10, your average cash flow would be 7.5. So you have not hit that hurdle because the 8% from the first year carries forward to the second year. So let's say then you did 10% again. Now your average cash flow would be 25. It would be a little over 8%. It'd be like 8 1/3. That third, you would then split 70-30 as per. So for arguments, so what you do is you carry forward the interest of the preferred return until you hit it. Once you hit it, then you start splitting it per year. So if you did, let's say you did 7 and then 10, you're at 17. 16 is what you need to give to investors. So you have a 1% delta over that 16% for 2 years. Then you would split that 70-30. So it is per year, and it's on cash flow and sale. If that's how you have it set up, now you can set it up different ways. You can split up cash flow and sale proceeds as 2 separate things. You could also have a recapture on sales. So what you could say is something like, cash flow, we're just always going to split 90-10. There is no preferred return. I think I should get some money every month for operating this thing, but I'm going to take a very small amount. Maybe it's 90-10, 80-20, 95-5, whatever it is. And then what you say is, on sale, I'll give you a preferred return of 8% and over that 70-30. So you would total up all the money you've given them in cash flow. If it hits, let's say it was 3 years, if it hits 24%, anything over that, you would then split 70-30. Even though you've taken some money in cash flow already, you just take the money that investors have gotten, add that to the pile with sale proceeds, and then say, okay, what is that total percentage? If it's 50%, the first 24% goes to investors, assuming it's 3 years, assuming it's 8%. Then anything over that would be split pro rata. You can also throw in other hurdles as well. Oftentimes we'll throw in a second hurdle to further incentivize us to continue to do better. So we may throw in a second hurdle at 12% and it flips to 60-40. So it's the same thing where, let's say we hit 8% per year, then on sale we had whatever, it's split 70-30. Once the investor then hits 12% per year, with us still taking that 30% between 8 and 12, so technically the total dollars is more than 12% on equity, but because you're taking 30% of that 4% delta between 8 and 12, once the investor hits 12, then it flips to 60-40, where we're taking 40% of every dollar over 12%, as just a way for us to continue to try to go more. Now, you could add 10 hurdles in, you could add no hurdles in. It's however you want to structure it, but it is per year, and it does carry forward. So if you miss in the first year and you hit 10% in the second year, you don't automatically get 30% of it. Usually, you could try to structure it that way, but most people aren't going to let you do that, or you're just not going to raise the money. So that's how that works. And that's the 3 questions for tonight. Second episode of Q&A show. Hope you guys enjoyed it. Hope you got some value out of it. If you have any questions on anything I talked about, I kind of went pretty in depth on the loan stuff, so I could see people having questions about that. Feel free to drop a question in the comments below. Feel free to hit me up on Instagram, LinkedIn, Facebook. Just search Chris Grenzig. You'll be able to find me. I usually get back to people pretty quick. If you haven't already, make sure you hit the subscribe button on YouTube. I'm trying to do more and more as things go on. Hopefully going to have a couple other things rolling out inside the next couple months. Just trying to add one new thing on top of another thing on top of another thing. So let me know if you have any ideas of things you want to see. If you have any questions you think would be awesome for this, I'm going to continue to try to do this weekly. Drop it in the comments. Shoot me an email, chris@tororep.com. I'll put it in the notes below. DM me on Instagram, LinkedIn, Facebook. Hit me with a question. I'll be more than happy to use it if I think people will get some value out of it. I'm always looking for questions to answer. And that's my show. Thanks for watching.